Hello and welcome to Crane Talk, a podcast that covers all things cranes, rigging, and heavy iron. My name is Isaac Smith, and I am joined today by two experts in the field, Ron Thompson and Aaron Jackson. Gentlemen, how are y'all doing?
Sir Isaac, it's always a pleasure, man.
It's a pleasure to see you guys, and it's a pleasure to do this in our new space, too.
Oh, you got to see our studio.
This
is great. I appreciate the additional resource and money put into this recording studio. So I'm happy. I'll come up here anytime.
Anytime. I almost live up here now, so I very much enjoy the new digs. But we have a guest today, and I'm excited to hear because some of the conversation you guys were having before we even pressed record. There's a lot to unpack today.
You know, we've been trying to get Aaron Jackson on this program for quite some time, and we finally did it. Aaron is a executive vice president for Redstone Underwriters. They are a program underwriting carrier that focuses on construction with a really heavy emphasis on heavy iron. And that's what we're going to talk about today. We're going to talk about the heavy iron part of this. And, you know, knowing Aaron for the last several years, he's really impressed me with his knowledge and expertise. He attends all the conventions. I mean, I see him at the SCNRA every time they have a meeting there. So, Aaron, I'm going to let you talk a little bit about how did you get started in this thing? I think you spent time with Zurich, and then you moved over to the risk theory company, which is Red Iron. Tell us a little bit about how you got here.
Sure. And Ron, thank you for having me on your podcast, Sir Isaac. To answer your question, I'm doing fantastic on a Friday in insurance.
Excellent.
As much as one can be. So quick background on myself. I started in the early 2000s with AIG claims. My first intro to insurance. I was more of the typical person back then. I stumbled into insurance. I didn't seek out insurance as an insurance career or a career actually. And from there, I migrated to underwriting. I went through ACE's underwriting training program. I worked for ACE, pre-Chubb ACE. So when people say Chubb, I always say ACE Chubb or Chubb, and I'm ACE Chubb. And was a risk part of the risk management group. Did large loss sensitive, large SIR programs for the construction group, which is both wrap up and practice policies. From there, moved to Ironshore. Ironshore is an E&S company, surplus lines insurance. I'm sure some people in the space probably have some familiarity with them because Ironshore provided the paper for a company that used to write in this space for a while. But I was a casualty manager for a territory for them for a long time before moving to Zurich, as Ron mentioned, where I was a construction casualty manager for a large territory for them, where everything Zurich offered from practice policies to wrap policies to professional to their SubGuard product, which is a subcontract default insurance product, to environmental for construction, all that stuff. I helped manage the portfolio for Zurich before coming to Redstone Underwriters. Redstone Underwriters is a wholly owned subsidiary company of Risk Theory. We have kind of four main core businesses within that group. We have our Redstone Construction Artisan Contractor Group, which is a broad form construction product. We have Redstone Express, which is like a limited form artisan contractor product. We have Stryker, which is a monoline commercial auto facility. And then what we're talking about really today, which is Redstone Heavy Iron, which is our GL auto full form access product specific to the crane and rigging space. And what an interesting space to be in, to be honest. When I first started in insurance, I was told to run away from cranes, not run towards them. And so it's been an interesting journey coming into this program and learning so much about it and some of the nuances that come from it.
Yeah, I think when you talk about Redstone, they've got some internal programs set that to loss mitigate, to help our clients reduce or eliminate losses. If you do have a loss, their rapid response claims model is unparalleled. When you have a loss on a Saturday afternoon, it could be a serious loss. You get a phone call. They don't ask, how's your family run? Mm-hmm. They say, hey, we've got a situation that we need immediate response. They have that internal rapid response claims model set up. And when you do have litigation or a big loss, they've got pre-selected defense counsel.
Oh, wow.
That they've vetted, that knows this industry, that can be immediate help, especially to preserve evidence on an accident site. It's all about response time. And the quicker you get there, the better off you're going to be in control of that claim. One thing I also like about Redstone is their contract management. We've talked about these work orders until we're blue in the face. And so they've contracted with an expert that has vetted all 50 states to meet that specific state statutes on indemnification and including incorporating some of the B30.5 ASME regulations adopted by OSHA. So that's a little bit about Redstone. You know, our listeners always want to know, if you're buying insurance, we're going to talk about heavy iron commercial, but it filters over to the homeowners and personal lines. It's the entire insurance industry, and there's pain right now. Everybody's got some insurance story about increasing rates, lack of insurance companies. They don't know my business. Aaron, talk a little bit about your opinion on what's causing some of these issues in the commercial market, specifically on heavy iron.
Sure. Aaron's his own unique insurance space. It's very low frequency business for the most part, but it's high severity. So from an actuarial perspective, it's kind of like the worst mix of things. It's not a lot of credibility because you don't have a lot of numbers to work off of, but it's high severity. And so really what's driving that severity? And a lot of it is things probably everybody's heard already via conferences or podcasts or just reading anything in an insurance magazine. But in social inflation, private equity funded litigation, things of that nature are all kind of fueling this. And what's interesting, I've been part of a couple of groups that kind of looked into different dive points on this. So the term social inflation is kind of a unique term that really wasn't spoken of in 2014. So when we were kind of compounding, like when you look at the mention of terms on earning calls of insurance companies, what phrases popped up a lot. And so, going back to 2014, fraud came up quite a bit. Wildfire was barely on the radar. Distracted driving was barely on the radar. And social inflation wasn't even mentioned. And then you look fast forward to 2023, which is when we can kind of get a good aggregated snapshot of a year where these things happen. Fraud is barely mentioned. Wildfire is still mentioned, but it peaked kind of around 2018, 2019. Distracted driving peaked kind of around 2018, 2019. But social inflation, starting in 2020 throughout, was the most common thing mentioned on these earning calls in regards to things to be concerned about in insurance. And so it's become so recognized that you have leaders in our industry, insurance industry, speaking about this. And it's not just internal industry discussion anymore. It's kind of communicated to investors, it's communicated to analysts, it's communicated to regulators. And this is all impacting the narrative of kind of what's going on in our little insurance ecosystem and driving up costs.
So is social inflation something, it's a term that I've become very familiar with in the last 3 years. It seemed to be post-COVID term that we're seeing quite a bit. What's driving that social inflation?
So I'll skip to a couple parts because I brought some of the things that we've done previously. But in this case, I'm going to go to realistically when they paneled juries and things that were on their mind, because these are things that are really important to us. And they did a jury research, and it was pre-pandemic and post-pandemic. And there's such interesting aspects of these numbers. And so, for instance, when people ask something like trust in the U.S. justice system, pre-pandemic it was 67%, post-pandemic is less than 50%.
Wow.
Yeah. And then no confidence in the U.S. justice system, pre-pandemic is 8%, post-pandemic is 17%. And there's, different things that go down, but large corporations being viewed negatively went from 27% to 45%. So when you think about the negative aspects from a social perspective that people can take, they got almost twice as negative, almost in every single aspect post-pandemic. I can't speak to psychologically or what happened, pre-pandemic to post-pandemic that shifted these mindsets so much, but it's reflected, I think, in our jury verdicts. And it also is reflected in why there's so much money going into private equity funded litigation to get things to a jury, because it's almost like you're driving something to a sympathetic audience. You're going to get the result that you want ultimately by driving it that way. And it's worth the money flowing in to keep it alive, to get it to where it needs to get to, as opposed to in the past, maybe we just settle the claim 3 months in or 4 months in, or, in a shorter time frame. And it really is interesting how it's driving up all the costs in and around our product.
Could it also be with the increased advertising on billboards, television, social media sites by plaintiff attorneys that are creating maybe, when you hear jury awards of $750 million, they kind of anchored the plaintiff lawyers, anchors a jury comparing that loss of life to a Van Gogh painting or a 747 jet. And so I think Texas Supreme Court addressed the anchoring part.
Okay.
I think they did. That could be part of it. And explain a little bit about this third-party litigation funding. We talked about it, Aaron, but I want to hear from your perspective.
Sure. I can actually touch on 2 points, and I'll get to the third-party litigation funding first. I'll get to the advertising second because I actually have some data that's eye-opening when you hear it. And I've been part of different groups that, different conferences where they talk about it. And so I've taken down the information. And third-party litigation financing is kind of like when an outside investor funds lawsuits, essentially treating litigation as an investment vehicle. So I've heard different aspects on the return on investment, but I've heard upwards of 30%. I've heard as low as 20%, but let's just say 25% is the factual number. That's a significant ROI for cash when you think about it. And it's a self-fulfilling prophecy. The more they win, the more people want to invest in it, and it kind of cycles on itself, and it becomes very problematic for people like me that are trying to underwrite to a profit and insure people appropriately and make sure that I'm around 25, 35, 55 years from now to cover their losses because that's my desire. It just increases the scrutiny and the ability, the acumen of what you need to underwrite to make that work. It increases the degree of difficulty. When you talk about advertising, now these are numbers from 17 to 21, so not exactly quite up to current, but over 5 years, plaintiff attorney advertising equals $6.9 billion. And the same point in time in 2021, just for pizza ads, it was $67.4 million. So you think about how often do you see a pizza ad on TV when you're watching football or baseball or basketball or whatever, and compare that to that 6.9 billion was spread out over 5 years, but divide that by 5, how much per year that equals, and it trumps pizza advertising. More people are seeing more billboards, more advertisements, more things for lawyers than they do for pizza. And that's got to shape your psyche or your mindset in some form or fashion.
I think 1976, the Supreme Court says First Amendment rights, attorneys can advertise. I don't think they realize what it meant in 2025. Every time you turn around, there's an attorney advertisement. But third-party litigation funding, carriers put up a certain amount of money, insurance carriers, for defense when there's a lawsuit. The plaintiff lawyers, if they've got third-party funding from private investors, they could raise $1 million, $2 million on a case and bring in expert neurosurgeons, expert engineers, expert this, expert that. And the carrier's model's not really set up to defend a $2 million pool of money that they're hoping to get $10 million on a verdict.
One question I have, because we talk about that a lot when it comes to the challenge that the legal team is facing, but you guys have a legal team ready, as I understand it, when some case like this comes up. What is it that they do to prepare? Like, is there any value that comes from seeing these over and over again to where they can skirt some of the issues that come with essentially an investment plan from the opposition?
I wouldn't say legal per se, as I would say claims first. So we have a rapid response claims model. These are third-party licensed claims adjusters that are there to get in front of the claim, start then protecting ourselves by acquiring or assigning the legal protections that we need. So we get the right experts, the right witnesses, the right everything else to ultimately make the claim, to get the best outcome on the claim that we can, based off the facts of loss. Because sometimes the facts speak towards something or away from something, and the facts will be the facts. But in saying that, even when I started in claims, and this was in the early 2000s, there was a lot of data around first contact within 1 day of the accident or the occurrence happening. And the ability to get it from somebody before to get an attorney and the outcome of that claim, the difference in the value of that claim was exponentially different. And so for us, that's why that model is so important to us. We want to get the right witnesses. We want to get the right experts. We want to retain the right lawyers to represent us because it's a very small space. And so if you wait too long, you might not be able to retain the people that you want to retain. So that's first and foremost, that's really important to us. But secondly, just getting in front of the parties that were impacted by this, talking to them and trying to work something out before they feel the need to get to an attorney or to seek representation is huge to the total value of the outcome of the claim. Because, as mentioned with this third-party litigation funding, really what they're doing is they're kind of bankrolling this potential plaintiff while they seek an outcome that could be greater than what the plaintiff would have settled for and ultimately needed. That's important there overall. And so that's why it's really important for us to get in front of it.
We've had recent claims, I'm not making this stuff up, where we have video, we have dash cams or side cams. So we had video of the other party creating an accident to our vehicle or crane. And they get out and they get on the phone. We've had 2 of these, and they're on the phone with their lawyer. Now, when you're in an accident, I call my wife, not the lawyer.
Right.
So this hiring immediate representation seems to be more than just an offshoot. And 2, Aaron, we're seeing, we used to get letters of representation. We represent so-and-so client on the plaintiff's side. Now they're skipping that one. We're just getting sued. And so they just file the suit. They don't even give a warning. And so we're seeing more of the suit file before we even knew they had representation. So anyway, that's a little bit what's going on that. Talk to us a little bit about some other things that are causing this really tough market we're in right now.
Obviously, capacity available in the marketplace for specific risks is a big driver, and ultimately the amount of markets that are competing for the same risk, which ultimately will drive down costs. And so at a good, healthy insurance ecosystem, the more capacity you have coming in, ultimately it's better for the consumer, which in this case would be the insured, because we're competing for business. And so when we start seeing too many adverse claims, or we start seeing things act outside of the rates, the rules, the terms, or other things where it's increasing our loss ratio or impacting the loss ratio negatively, it starts taking capital away from a specific segment. I just got back on Thursday from San Diego, California. There was the Wholesale Surplus Lines Insurance Association conference. It's a kind of like a big marketplace conference where it's all focused on surplus lines. So it's a lot of wholesalers, a lot of hybrid fronted carriers, it's a lot of some reinsurers, and a lot of MGAs, MGUs, and things like that. And a consistent theme in it was, there's a softening of the property market going on. Now, granted, it depends where you're at in property, how soft that is. But the casualty market was consistently described as lumpy hard, and meaning that specific pockets of casualty right now are starting to see some relief. But it's very specific. It's a specific class, it's a specific territory, it's a specific thing. A lot of it focused on manufacturing or things outside auto liability or general liability in the construction trades. But you could hear about that. But then when it came to excess capacity, regardless of anything, so separate of primary casualty, excess casualty, it was consistently, but man, it's hard to find excess casualty. Man, we can't get the layers we used to get. Man, we can barely get somebody to put up a primary one, or an excess one or an excess two over the primary. That's really difficult nowadays. And I don't see that changing. And I think all the things we're talking about with social inflation, third-party litigation funding, all that stuff feeds into that the excess market is really what's taking it on the chin right now and taking away capacity in the marketplace to make us compete and really drive that number down.
And when Aaron talks about excess market, he's talking about umbrellas. So when he's talking about the first 1 or 2 mil, like you have the $1 million primary general liability limit, auto liability limit, and anything above that is going to be building excess limits of coverage. And so if you're on that $1 or $2 million first layer on the umbrella, you're going to get hit because the claim that used to be $200,000 are now $2 million, right? So, and we're seeing, if a client had $50 million in excess coverage 3 years ago, they're probably buying half that amount today because of capacity issues and at a price premium standpoint. It becomes unaffordable. But we're also seeing our clients, customers, requiring higher limits.
Right.
So the client's reducing limits because of cost, and they're getting requests from their customers to get higher limits because when a claim happens, it makes headlines in this industry. And when somebody reads the headlines of a $765 million verdict, everybody goes, well, let's review our subcontractors that are operating tower cranes or mobile cranes, and let's put in a higher limit. And it's a difficult situation with that.
Has there ever been a situation where there's so much coverage that they have to have, and it's just not possible to find?
I hear about that more.
Really?
Yeah, where people want, they've historically bought $100 million in umbrella excess limits over the primary, and because of cost, because of capacity, they just can't quite fill out that $100 million anymore. It's just not available to them like it once was. And that I hear the story way more than I used to. I actually grew up in a cycle where, not to say it was quite a commodity, but it was kind of commoditized at that point in excess. And, for me in a prior life, I could put up 50 million in capacity. Like I could do a 50x of 50 or a 50x of 100. And you don't see excess slugs like that being put up anymore in towers, to my knowledge, at least, until you get XF 100 or 150 maybe. Very
rare. I think the last kind of $100 million limits were maybe 2 or 3 years ago. Now they're paring them down. I remember not so distant, maybe in the last decade, where everybody wanted the auto liability. That was the lead line of coverage when you submitted a risk. We'll lead with the auto because we want the auto. Now the auto is the toughest line of coverage because anything that rubber meets the road, when you see lawyers advertising, they're not advertising about a job site catastrophe. They're talking about a trucking company over the road, smashing into stuff. And that's where the pain is right now. Used to be the best line, and now it's a very tough line to underwrite.
And to follow up on that, I mean, I have two things there that kind of speak to it. So part of one of the presentations is, they talked about verdicts greater than $1 million. From 2005 to 2011, there was only 79 verdicts greater than $1 million. Older information. 2012 to 2019, though, 265. That's a 235% rate increase in verdicts over $1 million. And I think, it depends on the market, but I think people started feeling auto liability pain starting around 2016 to 2017 in rate increases. And that's because there was a lag in, getting these results and actually adjusting. So I don't disagree. For a while there, auto was the leading market. Let's write more auto. Let's write more auto. This is profitable. And they started writing it. And auto has a little bit of a tail between 2 to 4 years, depending. And I think all of a sudden everybody realized at the same time, wait a second, these trends are going really adverse really quickly. And it's kind of feeds to that 235%, improvement, I guess you could say, or increase of $1 million verdicts. And people weren't prepared for that.
And when Aaron talks about a tail, when you have an auto claim, the insurance companies puts up a reserve on their anticipation of what this payout will be at closing time. But in 2 years, when we had a reserve at $25,000, more evidence comes in, the plaintiff lawyers gets more expert feedback, and now that claim is $250,000. So the tail means 2 years later from the date of loss is a 2-year tail, and those claim reserves keep going up and up and up. And if it's litigation, it could be 4 or 5 years before you find the final settlement. So that a claim initially at $25,000, year one, settled out at $750,000. And that's the issue. It's hard to underwrite when you cannot pinpoint that final settlement amount after 4 or 5 years. Aaron, there is some success stories. We talked about the Texas legislature addressing some of the lawsuit abuse. I think the latest session could have been better in Texas. It's a 2-year, every 2 years they pass bills. So the next session will be in 27, I think. So Texas didn't get what they wanted on the final bill on lawsuit abuse reform. But Aaron, you got some success stories where it does work.
Yeah, so it's interesting. So, and kind of preparing for this conversation and just pulling out old notes on different things. And as we talked about, I started my underwriting career with ACE, so I like to listen to Mr. Evan Greenberg and stuff like that. And so there was a recent Chubb and Marsh CEO on litigation investment industry, and just their thoughts around it. And it was Evan Greenberg, CEO of Chubb, and John Doyle, CEO of Marsh McLennan. But in the article, it speaks to Florida, which Florida in 2023 passed some tort reform, and some of the aspects that have come out of it. And 2 aspects that come to it: early results. 2024 verdicts in Florida dropped by 40% in 1 year, and the total damages awarded fell greater than 60%.
Aaron, say that one more time.
Sure. So early results, 2024, nuclear verdicts in Florida dropped 40% year over year. Total damages awarded fell greater than 60%. So there's probably more devil behind the details than I have in regards to the article, but just on a surface level, that shows what tort reform can do and the proper environment to help what we're talking about.
If you're relocating, I'm going to pick on California. If you relocate from California, I think due diligence is to look at the jurisdictions and look where is it more business friendly to protect my assets from a large lawsuit. And if you're looking at what Florida did on their tort reform and what Texas should have done but didn't, to me, that would be a big factor. And Texas is a pro-business state. And they didn't get what I think the businesses wanted in Texas. So another 2 years, these bills will be brought up again and see where it goes.
We'll see what happens.
And you mentioned, pro-business, but this affects insurance buyers. And insurance buyers are people. Like I buy insurance. I have homeowners, I have auto, I have various insurance for whatever things that I have out there. I have a son that's about to turn 16, so I'm about to spend a lot more on insurance than I probably would like to.
Aaron, 16. Oh, those auto rates are cheap.
So, but they talk about, these verdicts impact, when you think about the burden felt on the average economy, it's been estimated that roughly it's $66,700 roughly per family. That's what these extra burden of these economic damages translate. And that's to individual buyers who just skip commercial insurance, just personal insurance. It costs us all more money.
Well, we're in a low inflationary environment right now. No, I'm being sarcastic.
Go on. Yeah.
It's tough. It's tough for a family out there right now because of the economic conditions, inflation, cost of housing, cost of insurance, and then that additional tax burden because of litigation is I call it a tax, $6,700 per family. Let that sink in. Do people budget that,
No. And with that all going up faster than the actual rate of people getting raises of their actual take-home pay increasing, no, it is a tax.
Yeah.
Well, we've talked about challenges in this current market. Aaron, will evaluate risk. He is the one, if you were to buy a insurance policy, whether it be liability, auto, workers' comp, he is the one that evaluates in his team whether it's going to be a proper risk or not. And if it does come on board, what can be done to mitigate and make that client a really good risk for Redstone. So are you positive going forward, Aaron? Is there a light at the end of the tunnel?
I'd like to think so. There's a lot of conversation around, if you didn't have the long-term liabilities, people have been writing this space. Are we at a rate level or at a space level where if you came in kind of new, you'd be able to project that you would make the income or the return on investment that most people look for when they invest in insurance. Some arguments are getting closer to yes on certain spots, and some arguments are still not quite there yet. So, as an underwriter, what I would typically look for, to make yourself look as good as possible, to get the best rate as possible, to get the best terms as possible, is really working with people like you, Ron, but also working with you well in advance. Because in a tougher market, having all the information needed, which obviously, Ron, more than a lot of people in regards to what we require for Redstone Heavy Iron, getting that information as quickly as possible to you, to get it as quickly possible to us, so we can have a negotiation, we can have a conversation, we can get out there and maybe visit the insured, we can maybe have a loss control visit. Because all those things, when you start stacking them on top of each other, it's potential for a credit or potential of some sort of rate relief or some term that could be removed that would maybe be more beneficial to your client ultimately because they deserve it. But if we get that information super late, if you get that information super late, so we get it super late, it's harder to have those conversations, and it just puts them in a bad spot. And there's a lot of good insureds, I imagine, they get put in bad spots sometimes just because the information comes in so late. There's not a chance to have that evaluation, that negotiation, that ability to really understand what that insured does. And that's really crucial to us because ultimately we want to charge the right price for the right risk.
Talking to our staff here, we're working on both sides, on Aaron's side and our side. I think twice as hard as we were 5 years ago. And the reason is there's more emphasis on the data and data collection. And on the broker side, the Ron Thompson side, data collection is the hardest thing for us to do because everybody is super busy. And so you made a great point, Aaron. If you go out 90 days prior, 120 days prior to the renewal date and say, this is the data that we're going to need, and if we get it early, we can negotiate a reduction in insurance premiums if it all works out. If we get it late, then it's going to be tougher negotiating lower insurance premiums. And Aaron's right on target because the more documentation that Aaron has and the underwriting department has, the better they can evaluate and better they can apply credits if credits is due. And we're going back to, we discussed telematics. We're blue in the face. We've discussed the OSHA regulations that you can apply if there's a loss on a job site. So all these are important things to have. Driver training is huge. We still see repeat drivers having accidents. And we go, why are we still having these accidents? We've got an account over here that has 200 units. It has 2 accidents a year. We have a client over here that has 10 units. It has 10 accidents a year. So there's more emphasis on the training part. And Aaron's correct. The quicker and earlier we can get data to the market, better negotiating their renewal premiums or premiums in general.
Is because I'm looking at your website right now and it has a whole section talking about risk management tools and the importance of the impact these things can have. But is it something you could actually quantify for us? Like, let's say that I am a company and I get you that information the 120 days prior. Like, put that in perspective. What is the quantifiable difference between that and doing it last minute?
From my perspective, so first and foremost, Ron mentioned it. The insureds are obviously their focus is their job. There's things that make them revenue, and it's not sending insurance documents in. And so I appreciate that. For my staff, though, fundamentally, they're also paid to underwrite business profitably and to produce underwriting premium for us. So the more opportunity they have to look at something, the more they can triage it and identify what is the right thing for me to focus my time on and what is something that's not as lucrative for me to focus my time on. So there is something to, where you fall in that stack of, are you going to get the full focus of that underwriter because everything's there, they have all the information they need, their ability to evaluate it, or is it coming in late and it's being piecemealed, and is that a good use of my time? Because we all have a limited amount of time. So that is huge. As far as the contracts go, or the contract management that we like to have with job tickets or just contracts in general, we have plenty of claims examples where those job tickets have provided us the ability to get out of a claim that we ultimately might not have been able to get out of. As Ron has mentioned, as people probably know on this podcast know, between OSHA and ASME, there's standards involved that are different for a crane operator than they would be for a contractor. And the ability to have that kind of agreed to in writing and to demonstrate that can be huge. Ron also mentioned telematics, and I'm going to go a step further with cameras. Cameras are phenomenal. We have absolutely got out of a lot of claims that could have been either worse or got out of them completely because of the camera. And it could be as simple as we have a camera that demonstrated the speed of the mobile crane traveling through an urban environment. Some person swerved over, almost like stop and squatted. They hit them, and they're below the speed limit. There was nothing they could do to avoid that accident. The person gets out, is talking to the person, laughing with the person, everything else. Police show up. All of a sudden, they're leaning against their car. They're grabbing their back. They're saying that person was speeding. There's all these things there. And that camera is just indisputable proof. This is what happened. They were going 37 and a 40. They had no opportunity to brake because that person cut them off. That person was absolutely fine and joking around with that person up until the moment that the law enforcement showed up. And then all of a sudden there's a different reaction. That stuff's huge. And it saves us money. And it's important to us. It's important to us when we're qualifying a risk that they have those things. And there is a meaningful premium reduction that probably more than offsets the camera cost when it's all said and done if they were choosing to invest in it.
This is how we sell the cameras. We've had clients do side, even rear, by the license plates, and of course, inward and outward facing dash cams. And when you go out and go over the loss runs with our clientele, and there's $1 million reserve for over the road, and they're going, what's going on there? And I said, well, as a he said, she said, they got lawyers. Now they're bringing in expert witnesses, and that reserves $1 million, but you don't have video. And they're going, well, would it make a difference? And I said, it makes all the difference in the world. And so those clients spend the money to buy the video. And like Aaron said, it's not that expensive. And so when they see those reserves on their loss runs, that's when they usually will start paying money to install the cameras. And we've had video sent to plaintiff lawyers, right? We never hear back.
Client's been dropped.
Yeah. I mean, we don't, they don't tell you to drop the case. You just never hear back.
Yeah.
So video is huge. And Aaron, I think it's becoming more of a requirement than hey, we recommend video. We have some partner carriers that they're just, you either have cameras or we're not going to quote your insurance.
Sure. And so when you say, hey, what are things that can go to my group and make it look better? Somebody that has cameras versus somebody that doesn't have cameras. There's a difference in risk quality there from our perspective. Somebody that utilizes good job tickets or good contracts versus somebody that doesn't. There's a value there to us that we care about as far as like when we're underwriting and evaluating a risk. Working with a good agent. That's not me here in this room just saying that. That's factual. An agent that will go through and look at a contract and redline something or say, hey, you really should remove this portion of the contract, push back on this. This isn't fair to you, and this is something you can push back on because of our experience. We know this person might remove it. That brings benefit because all these things add up. There's not one silver bullet for anything. You're really just kind of fighting and clawing to get a couple points here and a couple points there and a couple points there, but it all adds up in the aggregate, and it makes for a better risk that's going to get better premium, and from my perspective, generate a better loss ratio. So it's good for all parties. The outcome is beneficial to all parties, and that's really what we're looking for at the end of the day.
So the contracts he's talking about are the subcontract agreements that our crane and rigging clients get from their customers. It might be a developer, it might be a general contractor, might be the owner. And these contracts are very arduous. They're written to favor the customer. And so we go in and we get quite a few. And, we say we're not rendering legal advice. We're advising you on certain things. But you look at certain aspects of that contract and they're really nasty, especially when it comes to lien laws and liquidated damages and scope of work could be very broad, where Greiner might just be picking the HVAC unit, but the scope of work is huge. And so we try to address it to our clientele and educate to look at these different clauses. Venues, if there's litigation, it'll be held in Orange County, California. Well, the job took place in Austin, Texas. So we have them to make sure you change the venues on these contracts too. We don't want to be flying to California if there's a mediation or an arbitrated case. So those are huge. Let's talk about some of the emerging trends you're seeing, Aaron. Let's get in a little bit of that AI talk.
Sure. So I've had the pleasure of attending some of these tech conferences over the last few years. And I know we kind of go through these iterations in tech where everybody gets excited about a certain thing, web-based, cloud-based, big blockchain, things of that nature. But this AI seems like it actually is something that not only is here, but it's probably here to stay. And it brings so many advantages in so many different ways. I'm going to go to an underwriting perspective. You can see it in claims, though. Honestly, there's a lot of claims AI out there that's going to be hugely beneficial to claims. There's some agency stuff for AI that I'm sure will be beneficial to the agency side. But the ability to utilize AI to enrich data that we already get. So, from as simple as insured location, utilizing the things that are around that insured location, credit analysis on the business itself, public records available on that business that can just be pulled from any public database, and a lot of various things that can be pulled together to give what they call a risk score. And you're hearing that more and more, especially when you talk to various parties that want to put capital into insurance or reinsurance or whatever. Risk scoring, like how do you risk score? How do you differentiate between X and Y? And AI is a big function of this because they have all these tools now where they can pull from these different resources, and the ability of artificial intelligence and the ability of all the things available in the universe that they can pull from has become so much more meaningful. I realized just a year ago, I didn't even know this existed. There was a camera company that partners with most of the cities, and they snap license plates, right? And so they're, red light cameras are just in general snapping license plates showing time, date, stamp. Well, that was being provided for cities for different reasons, but they're aggregating this information. So from an insurance perspective, how could that be useful? Well, does that vehicle travel local radius? Does it travel intermediate radius? Does it go out of state? And you can actually put in a license plate and it can tell you, yeah, this license plate was snapped in California. They're at Texas risk. They say they never leave town. And that's stuff that can be brought to you behind the scenes, separate of anything else, and AI can provide that to you. So from an underwriting perspective, it's just a way to get more information to verify the accuracy and the validity of the information that you're getting, and also hopefully to find more reasons that you want to write it, not less reasons, honestly. But all of this is coming together, and this is all becoming more and more available, and there's going to be more and more of it. And it's going to allow us to get to more files more efficiently with more data, and hopefully allow us to get to quicker outcomes, but better outcomes ultimately.
I had not heard the term ChatGPT 2 years ago, and we're talking about this before the podcast. I use it. I know everything I do. If I don't find it there, I'll go to Reddit. And Aaron, we talked about before the podcast, some of it's not accurate. You've got to really filter, but it's a great guideline. And I think we're just at the beginning of this stuff, Aaron. And when I heard a webinar 2 years ago, and they were talking about AI, ChatGPT, I was lost. I had no idea what they were talking about. 2 years later, I got a little bit of familiarity about what the AI can do. And claims, I think it's going to be a huge game changer on the claim side.
Yeah, the ability to drive down your ALA and your ULA, quite frankly, the LAE portion of any insurance risk is huge to your portfolio. You take a couple points off that, it improves the entire portfolio by a couple points. And I think there's a lot of upside on that.
And when Aaron uses the acronym LAE, it's the loss adjustment expenses on a claim. Could be a lot more than the actual claim itself, because you have defense counsel expense, you got adjuster expense. We haven't talked about it, but they use forensic engineers to go out and recreate the accident site. All that's are expense items that goes into the loss adjustment expenses of a claim. So if you file a lawsuit, Sir Isaac, but don't file it against us, and say your payout's $100,000, the insurance company may have had to spend $200,000 on getting the proper defense set up. So that's what he's talking about. If AI can reduce that loss adjustment expense by 2 percentage points, it's a huge on the combined loss ratio.
Makes a material difference.
Yeah. Well, we're sitting here. I wanted to get Aaron's viewpoint, because on these podcasts we've been, we've had guests, but it's from more of a broker standpoint. But Aaron brings, what goes on at the actual insurance carrier in the underwriting process to evaluate risk. And do you stay up at night, Aaron, or is this market, it's affected a lot of people?
Yep.
And my team, I keep saying, we're going to have to include psychotherapy as far as the employee benefit to get through this. But we will. It's a cyclical industry. The industry will figure out how to bring profit and maybe stabilize these rates, because the rate environment's been tough for the last 9 or 10 years. But I've been personally through cycles where it's very soft. You saw rate decreases in those cycles. I haven't seen it in a while, but I'm assuming they will come back once there's the profitability aspect coming back to the insurance companies. Reinsurers are a big play. And are you involved with the reinsurance?
Yeah. We do have absolutely conversations with reinsurers. So, we utilize Amherst Specialty Insurance Company for our paper for the most part. And that is proprietary to all risk theory MGAs, MGUs. So we kind of have our own insurance company of sorts behind us. So we retain risk. So we can choose how much we retain or don't retain depending on what we like or don't like about a specific risk. But we do talk to reinsurers. And obviously for them, depending where they're at, property versus casualty, just a few years ago, everybody was joking, you didn't want to be on the property side. I'd rather be on the casualty side. That's where the fun's at. And I think it's completely flipped in the last 12 months, 6 months, I guess, probably, where property is a lot easier to play right now than casualty. And so all those percentages we talked about earlier, like the 256% increase here. I had another slide where it's like a 967% increase from 2010 to 2018 on the size of a verdict for trucking. All that's been taken on the chin by people that help supply capacity and capital to the marketplace. So we have plenty of it. So there's plenty of options and people have choice in their insurance. And so they're definitely cognizant of all the things we're talking about. And they definitely want to get to a place where they can feel more confident that when they put money into our market space, it's going to get them the return on the investment they're looking for. Nobody's looking for sympathy. We choose our fortune. We choose to place capital or to place risk where we choose to place it. But the ability to more often than not, give the return back that's being expected is really good for the ecosystem. It gives the insurers out there more opportunity to find more people competing for their business, which ultimately is going to drive costs down for them.
So when judges have fundraisers, for the election, they invite plenty of donors. And a lot of those donors are plaintiff attorneys. And I had a defense attorney. I said, do you go to these judges, the fundraising where they're elections? He goes, yeah, I'm the only defense lawyer there. So, some of that has to change too. Aaron, closing discussion, man. Are you looking forward? I mean, do you see this thing turning around? I mean, we talked about, light at the end of the tunnel. I'm a glass half full guy. And so I really feel that this thing will turn around. And our clients are getting very educated about the market.
Sure.
And about what resources they need to put in to make their risk quotable and profitable, for an insurance carrier. So, any closing comments?
So the things I've seen recently and think we see more of is just alternative ways to insure their risk. I feel like there's more coming out there for a lot of your clients and the clients in this space, separate of, construction and auto, just grain and rigging focused. And so it's kind of alternative vehicles. We can kind of bet on yourself a little bit, and that can go either way, right? It's a different arrangement. So I think we're going to see more of that before we see more just straight practice policy, lower deductible insurance rate relief. I do think it will be on the horizon. It depends who you subscribe to, when that's going to come. I would still think maybe 18 to 24 months out, things can change. But a lot of things you read in different press releases and whatnot speak to, it keeps getting pushed out, but, maybe second, third quarter 2027. Some will say maybe as early as fourth quarter 2026. You start seeing more rate stabilization. Now, rate stabilization might not mean rate decreases, but also might not mean rate increases. So, time will tell. Getting a hold of this, all the things we talked about, social inflation, third-party litigation funding, tort reform, all those things will go a long way to stabilizing the space. And it might become state-specific because certain states adopt things, which makes it more attractive for us to focus there than other places. And so it might not be everybody wins. It might be some places win more than others. And that's because their legislature took the time to pass meaningful tort reform to bring more people willing to play in that space. And I hope we see it. I really hope we see it sooner than later.
Well, I saw 3 or 4 states that did tort reform. I think Louisiana had some sort of some tort reform.
Yeah,
Iowa maybe. Florida was a cesspool for a long time, and on the homeowner side too. Carriers did not want to write in Florida. For many reasons, but there is hope out there. I'm happy to have your input. We always close it about some personal things. What does Aaron Jackson do when he gets away from the office and gets away from taking phone calls from brokers and claims adjusters? Tell us a little bit about what Aaron does.
I don't know, Ron. I love this game so much. I just can't imagine doing anything else besides it. No, besides the insurance calls and maybe a martini or two every now and then. Typically, for me, I live in the DFW Metroplex. So it's spending time with my family. My wife's actually in insurance as well. So we have the most boring discussions you can ever imagine when I get home. I have a son that's about to turn 16. So we're panicked parents right now with a son that's about to go out and start driving independently. And, we always see the worst aspects of driving, even though statistically it's still fairly low. So that's its own little nerve wrack in itself. But, ultimately it's traveling, it's camping, it's, getting the most out of what we can while we have time with our son that's, getting a little bit older and might be going to college not too far from now and enjoying that time period.
I've got a quick story. My oldest, when he turned 16, I had this brilliant idea of drafting a driving contract. And we had curfews and get tickets, you're paying tickets, and these are the do's and don'ts and the agreement. And, looking at contracts for all my life, I said, well, I'll just draft one up. And he signed it because he wanted that truck with lifts, the lift kit on it, on the day he turned 16. He signed it. So the next weekend, we had an 11 o'clock curfew. It's midnight. So he's already broken that contract. It's been 4 days into it.
He didn't read the fine print.
Yeah. So he came home at midnight, and I said, "Hey, man, dude, here's the contract." And he goes, tears it up. So that was the end of the contract.
Oh, wow.
But he performed well. But it was funny. I had an ideal I could get a 16-year-old to sign a driving contract, and he signed it because he wanted that truck.
So, Ron, in telling that story, did you think about your 16-year-old self and how you would have treated that contract at the same time?
Scary.
Yeah.
Scary. Yeah. You always worried about, your kids coming back, and we had three children, and we were always kind of pins and needles when, they're out on Friday night driving, but that's what parents do, right?
I guess so. I'll find out someday.
Well, you have any other children, Aaron, besides that?
No, we have our one son, and blessed and lucky to have him, and looking forward to see what happens in the future with him. But the turning 16 and the driving is going to be his own little adventure in itself. The lack of control in that situation is it's going to be a new one. I
can already tell you that Aaron's 16-year-old will have 6 cameras on the
He'll have all the umbrella packages in his insurance that
there's things that people don't even know exist that are going to be following his car around. We're actually going through that argument right now. How much do we want to monitor him? It's so funny because you have it available to you now. I didn't have it available when I was growing up. And so how much do you want to know and how much do you not want to know? It's an interesting question.
Yeah. Well, we didn't have a monitor. I'm kind of glad we didn't.
Yeah.
As a matter of fact, I met Aaron. I think the first time I met him was it was out in Bartonsville at Marty B's.
Marty B's, yeah.
And we had a cocktail there and solved a lot of issues. Some of them were insurance. So
if we would just remember the conversation, the world would be so much better, right?
I don't remember.
We might have tort reform already.
Exactly.
Yeah.
Well, I always finish up. I kind of get away from all this insurance stuff, but I watched the Emmys Sunday night. The Emmys are for television, of what the Academy Awards are for movies. And I watched a series by Netflix called Adolescence, and it was a fabulous series. It came out in March of 25, but it had 17 Emmy nominations and won 6 for Best Actor, Best Director, Best Supporting Actor, and Best Supporting Actress. Fabulous series. The youngest ever to win a Best Supporting Actor and an Emmy. He was 13 years old when he filmed this.
Wow.
Takes place in northern English town, and police raid a family home and arrest this 13-year-old kid on suspicion of murder of a classmate named Katie. And the psychological drama in this series was awesome. So if you're flipping around and if you subscribe to a streaming network like Netflix, check it out, because when I watched it back in March, I had no idea it would win 7 Emmys. So that's my review for the week. Aaron, it's been a pleasure, man.
Thank you. And thank you for that recommendation. My wife actually brought that up yesterday.
Really?
She was talking about the Emmys and said, hey, there's a show called Adolescence that won all the awards. We should probably check it out. So now I'm compelled to check it out. I have to. So.
Yeah, well, and one other thing about this, it was shot in a continuous one camera shot. It wasn't shot in takes.
Okay.
One continuous for the entire, I think there's 2 or 3 shows that make up the series. But talking about the acting, this was Netflix is now putting out fabulous material. The big screen's great, but these streamers are really developing some great programming. And this one was good. Aaron, I would definitely recommend that. 2 other, Seth Rogen did The Studio, that was nominated for 4, and then one called The Pit, which is real-time medical drama in a Pittsburgh hospital that got really good reviews. I haven't watched either one of those. I did watch Adolescence, and I recommend it.
Well, real quick in wrapping up, Aaron, if people want to get a hold of you or have any questions, how can they best reach out?
Sure. We have our website you can go to. So we have Redstone Underwriters, redstoneunderwriters.com. And from there you can find both construction and heavy iron and things like that. But ultimately, at the end of the day, if you really want to reach out to me, it's just ajackson@redstoneins.com. We'll find the appropriate party to get you to if I can't answer your question or if you have other thoughts. Or we'll get you the appropriate agent representative or producer representative if needed. So happy to take any questions, obviously, but more looking forward to see what happens in the near future in this space. There's a lot of good people and a lot of good insureds in this space. And I do appreciate that, they've seen their insurance costs rise for quite a while now. And so, from our perspective, we'd love to get to a level set at some point where that kind of settles and people can get back to doing what they do best, which is focusing on what they do for a living, not worried about their insurance necessarily.
Right on.
Yeah, and one last plug. We have used Redstone as a partner. Their claims handling, I find to be above what we see normally in other programs. So just a shout out to your claims people.
Yeah.
They do a really, really good job. Are you going to Indianapolis?
I will be.
Awesome. We'll see you Tuesday.
We'll see you Tuesday.
Yeah.
There you go. Well, thank you all for listening. Be sure that you subscribe and leave the show a 5-star review. If you have any questions, you can reach out to us using the links in the show notes down below. And with that, we will see you next time.